The once mighty PayPal just reported Q3 numbers this week, and Wall Street once again showed us more of the same with another decline here. The business is now down about 75% from those highs in 2021, despite beating earnings estimates. So we have to ask ourselves, with PayPal being a conglomerate in the fintech industry with decent customer retention and a proven business model, is this massive decline warranted? Or is this the perfect buying opportunity for us value investors to profit from poor market mechanics? We'll answer all those questions and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today, we are going to analyze PayPal's business and earnings results. We'll start with the fundamentals, looking through the top line, bottom line, balance sheet, etc. Finally, we'll conclude with an evaluation of this business using our intrinsic value calculator, which will identify the buying opportunities for PayPal. And if you enjoy this type of content, make sure to subscribe because we post on here regularly, analyzing the different fundamentals of the various businesses you're interested. So again, if that type of content interests you, subscribe, like the video. Without further ado, let's jump into it. Okay, and as always, just to start us off, we'll get some insight on this quarter from the CEO themselves. And they said they delivered strong third quarter results. They're continuing to invest against their key priorities to advance their leading position in digital payments and commerce. They're pleased to be working with Apple to enhance their offerings for PayPal and Venmo merchants and consumers. Okay, so they're name dropping their partnership with Apple in an attempt to excite investors. They're also continuing to execute on their long-term strategy to deliver profitable growth, yada yada. Okay, how has this business fared over a long-term horizon? Okay, we can see since 2012 they have been able to grow revenues year over year consistently. That's exactly what you'd want to see from this type of business. And then we have bottom line also growing year over year. Also notice we did not have a slowdown during that 2019 to 2020 period where most businesses did have a dip in revenues. Now, that being said, with clear growth and scale with this business, why are we down 75% year to date? Let's dig a little deeper, right? Let's look at this from 2015. They've been able to grow their active accounts from 181 million to 426 million. This was in 2021. Transactions quadrupled. Total payment volume went from 288 billion to 1.25 trillion. Okay, revenues almost 3x as well. And then finally, free cash flow also expanded. Okay, I'm still not seeing anything wrong with this business. Let's keep going. And we can see here, it looks like they're introducing a rewards program to their US consumers. This should actually impact the fundamentals as well in a positive way, since they're going to allow their users to redeem points, earn more money, and it'll keep them using their services longer. So more positives from this business. They're also saying here that they have room to grow up to 50% market share per region. All right, so essentially what they're saying is they have room to grow in their core markets up to about 50%, which they're not there. So they're expecting further growth across the board. But here's the first red flag that I've seen, okay? If you didn't know, they released a misinformation clause. And what is that exactly? Well, if we read what the article says, it says the company incorporated new terms within its acceptable use policy that included a $2,500 fine to users deemed to be spreading incorrect information. Okay, so if you own a PayPal account and you were deemed to have spread misinformation by any sort, they would have the authority to go into your account and deduct $2,500 from your account. Now, they swiftly retracted this clause because guess what happened? Lots of people started to close their accounts, and rightly so. What do they deem as misinformation in the first place? You know, it's very vague what they say here, and I think this was an absolutely terrible move, and it ultimately lost them a bunch of business. And they tried to say that this was published in error, but I'm just not buying it. I think this was just the wrong move on their part. But with that being said, let's analyze how this business has operated over the past few quarters. We can see their total payment volume. It's not really gone anywhere really. Yes, year over year, they did increase about 9%, but we can really see here, we haven't really gone anywhere since Q4 of 2021. We'll have to see how this transforms over the next few quarters. But then that leads us to our transactions and engagement. This actually has been growing, from 403 million accounts. Now they have about 432 million accounts. But I think what's actually better than their accounts growing is that their actual transactions per active account has grown as well. This has grown from 43.5 up to 50.1, meaning not only are accounts growing, but the active accounts are actually using their accounts more. So that's going to have a positive fundamental impact. And ultimately that leads us here where we can see again, 432 million accounts, number of transactions, that's up to 5.6 billion this quarter. We can see this is something that has grown pretty much year over year as well. All right, so that's solid and will have positive fundamental impacts as well. Now let's look at this from a regional perspective. We can see here US net revenues are up to $3.9 billion this quarter. Again, something that's been growing. growing quarter over quarter, year over year as well, and obviously is majority of their revenues. Then we look at this from an international perspective. We have $2.8 billion in revenues, not necessarily experiencing that same amount of growth here, especially on a year over year basis. We have had some slowdowns here, so they really need to improve that side of the business. It does account for 42% of the business, so you'd want to see stronger results there. That ultimately leads us down to our statement of income. Altogether, they produced about $6.8 billion for this quarter in revenues, up about $700 million from last year. Add all our expenses together, that's an increase up to $5.7 billion from $5.1 billion. So all in all, grew revenues by about $700 million, let's call it, but then grew expenses about $600 million. It only results in, let's just call it a $100 million impact. But that $100 million does actually still equate to almost a 10% increase year over year in operating income. And we look at this from a 9 months perspective. Again, same thing, $20 billion, up just less than $2 billion. But then we look at our operating expenses, we're $17.5 billion. That's up over $2 billion. It ultimately led to a operating decline here year over year so far on a 9 months perspective. We'll see how the fourth quarter turns out with the holiday season approaching. Let's take a look at how their liquidity looks. Okay, $10.6 billion in cash on the balance sheet with about $10 billion in debt. So the balance sheet is clean. Nothing to worry investors on the balance sheet at least. And then we look at this from a free cash flow perspective. Net cash provided from operating this business was about $2 billion this quarter. Deduct our small capex figure here. It doesn't take much to run this business of $182 million. We're left with $1.7 billion in free cash flow for this quarter. Strong numbers there. What are they actually doing with it? Well, they're really just repurchasing shares. And just to give us a little bit of a bigger picture here, look at this from a 9 months perspective. Again, majority of their money is going to repurchasing shares, and then they are taking on just a little bit of debt here as well. So from the results that we've seen so far, is this really warranting a 75% decline in the stock price over the past year or so? I mean, yes, they did have a suspect policy as well that was released. They do have some competition as well, trying to take over some of their market share, with some consumers unhappy with the transaction fees. But all in all, this business is growing, and they're saying that by the end of the year, they should have free cash flows of at least $5 billion. So with that in mind, let's use our calculator to identify if this is a buying opportunity for PayPal. All right, and because this business is able to produce a large amount of free cash flow, let's use that in our calculation here. So I put in the $5 billion that they're expecting by the end of the year. If we require a 10% return, they are not paying a dividend. And if we estimate that on the backs of an economic rebound globally, this business can start to grow at, let's just call it 15% for the first 5 years. That drops down to about 7% on a 30 PE. They're currently trading at about a 44 PE. Then this stock would be worth about $145 per share. Right now we're trading at $75 per share, basically 50% off from what these growth estimates are projecting out into the future. Now let's look at this from the very best case scenario. Let's say they're actually able to achieve 50% market share like they're projecting across the various core markets that they have. On top of that, their rewards programs has a positive impact, their partnership with Apple, etc., and that they're able to grow at, let's just call it 20% for the first 5 years. That drops down to about 12% for the 5 to 10 years after that on a 30 PE as well. Yeah, we'd be looking at about $215 per share. Again, significant increase from the current price of $75 per share. Now, in the very worst case scenario, where more users look for other alternatives for their payment processing, etc., growth starts to really slow down, not only in their international segment, but also in their US segment as well. Let's just say they can only grow at 5% for the first 5 years. That drops down to only 1%. 5 to 10 years after that on a 20 PE, yeah, the stock would only be worth about $50 per share. But look at this, guys. That's only $25 essentially off where we currently are trading. And that's in the very worst case scenario where for the next 10 years, we're barely able to grow. I mean, imagine if they also start to pay out a dividend in the future. Yeah, this business is really going to take off. But that being said, imagine we do have further losses. Maybe they only produce, $3.5 billion in free cash flow going forward, and they don't pay a dividend. Yeah, let's see how that impacts it. Yeah, I mean, even in this scenario, we'd still be looking at significant share increases in our expected and optimistic scenarios. So it really just depends on what you believe this business can do going forward. Are they going to start to grow as they did in the past? They went from $50 up to $300 over like a 5 to 6 year period. I mean, it's not entirely out of the cards for them to do that again. But let me know what your thoughts are on the future projection of this business in the comment box below. I'd love to hear. That's my analysis. If you've enjoyed it to this point, like, subscribe, and I'll catch you on the next one.